Hey, good morning, everyone. Marty Missouri here, August 14th, 2025, Thursday morning. 2.5 hours after the market open as I speak. This may be it for the week. If over the weekend, after I go through my macro exercises, if I think there's something of interest to share, I will certainly do that. Otherwise, Tuesday, Wednesday of next week will be my next video. This morning, I wanted to keep it pretty quick. I don't think we need to spend hardly any time on the charts. I do want to show you the monthly charts on the S&P and the NASDAQ, and we'll take a look at a couple other things there. Wanted to talk first about this morning's Producer Price Index report. It was kind of a shock to the market. In futures, the markets reacted right off the bat. I think the S&P was probably down 0.5% or so, but nothing extreme. But they were actually up pretty nicely before the report. So unlike the CPI, which came in pretty close or close enough to expectations to spark a rally in equities, PPI came in way above expectations. They jumped 0.9% just on a month-over-month basis. And the estimate was 0.2%, so that's pretty dramatic. On an annualized basis, the 3.3% is the headline, 3.7% is the core, which X's out food and energy, and those were 2.3 and 2.6% the month before. So yes, as you might suspect, tariffs are showing up in the mix in producer prices, and I want to talk about the potential for what that could do to profit margins here a little later in this morning's presentation. There's a common thought, and I certainly understand it, that we shouldn't get too bound up over tariffs relative to inflation because, they're just a one-time hit in theory, right? That, you have a 15% tariff on a product coming from Europe one month. Well, it's going to be 15% the next month. So it's not like that price is going to rise because of the tariff thereafter. But, it's never that easy when it comes to economics. Henry Hazlitt, one of my favorite economic thinkers over the years, he wrote a great book, by the way, Economics in One Lesson, I think was originally published back in the 50s. But it was a book that was very educational for me certainly in my formative years. But anyway, he makes a comment there that bad economists only see what really shows up on the surface. Good economists look well below the surface to draw their assertions or conclusions about what's going on. So when you think about this tariff notion, and you hear this constantly, don't worry about it, it's just a one-time hit. Well, among other things, let's think about it in the terms of supply chains, right? If it mucks up, so to speak, the supply chain mechanism throughout the world because countries are getting cute and trying to avoid tariffs here and there. But all of these avoidance mechanisms, do come at higher costs and so on. And then you have a situation where maybe in the beginning, the companies try desperately to absorb and mitigate the hit from the tariff. But how long can they do that? Again, I'm going to talk about it within the context of profit margins. If they feel like they can, or to the extent that they can, they will pass those on, perhaps incrementally over time to the consumer. But if they can't, now we're not talking about inflation, but we're talking about to hit the profit margins. And I'm going to show you here in a minute why that is something that concerns us right here. Okay, so that's that. That explains some weakness in the market today, although the S&P is coming back. I do want to talk again about breadth, but just within the context of today's trading session. We took a pretty good look at breadth here on Tuesday's video. But first, let's just look at the S&P monthly chart. Remember, folks, back here, I said you don't want to get overbought on the monthly in the relative strength index, which is the latest pricing relative to the last 14 months. And when it gets too extreme, it's kind of the speed of the move gets into what they call this overbought territory. On the monthly, it almost always resolves in somewhat of a corrective action. You see we got overbought here, and we had a 20% correction here earlier in the year. We got overbought here, 27% decline, overbought here. 18, actually 20 and 35% declines. You get it. Overbought, 16% decline. Overbought, 57% decline. Overbought, 50% decline. So we're now, right now, technically in overbought territory. Kind of a tough season typically for the market. Market is holding up very nicely, as you can see right here. But here we go, rising wedge pattern. Bearish divergence on this momentum indicator, the moving average convergence divergence, although that right there is a buy signal. But it's the slope that we're concerned about, and that says that there's some downside risk right here. Looking at the NASDAQ 100, which I don't really have marked up that much on the monthly, but nevertheless, you can see the the MACD is threatening to confirm this move into all-time high territories. Very overbought on the Qs or the NASDAQ 100 ETF, and you can see what tends to happen, 20+%, I think it was 33% there, and so on. So different index, but, we don't get here very often, and when we do, you just want to be a little guarded, or at least maybe expect some corrective action. I'm not saying the next bear market is going to start tomorrow, but it wouldn't surprise me over the next few weeks to see some more weakness in the market, just based on this one reading alone. Okay. Breadth for today. By the way, on Tuesday, I was showing you how awful, frankly, the breadth readings were. And then lo and behold, last 2 days, breadth was phenomenal. The S&P equal weight and the NASDAQ equal weight indexes did way better than the cap weighted indexes, and really big, really serious breadth days. And that would suggest, hey, we're getting rotation. It's not like the leaders need to crash down to catch up to the troops. Maybe the troops can catch up to the leaders. Well, today, not so much. In fact, right now, this is a delayed chart, but right now, the S&P is just pretty flat, actually. It's only down 15 basis points. It was down about 1/3% just a few minutes ago. So definitely we've got that buy the dip mentality going on big time. But still, though, the S&P equal weight index, which isn't cap weighted, meaning all 503 stocks get equal weighting, it's down close to 1%. It's down 0.9. And this reflects that here. So really right now, while the S&P is getting back to flat, there are only 2 or 3 sectors that are in the green. So by and large, the market's having a rough go of it so far today. This screen shows you that all but 3 sectors are in the red. Real estate, 1.25%. Materials, 1.2%. Industrials, 0.8%. So in a not small way. Communication services are up a bunch, 0.8%. And consumer discretionary, call it flat. Healthcare, call it flat. But only 20% of the S&P is up. 80% is down, and it's only down. The index itself is only down 0.14%. So that's that huge concentration that I've shown you in a historical context is something we should take seriously. And then right here, the Dow. The Dow is down. It's down 173 points. It was down more than that. But 22 of the 30 are down. 400 of the S&P 500 are down, and it's flat again. And 2,200 versus 694 up, 2,200 down for the NASDAQ Composite Index. And by the way, because we're broadly diversified, we're taking it harder than certainly than the cap-weighted index. Our portfolio, our core position is down just a little over 0.5%, 0.53%. But again, the equal weight index, which is more representative of a broad-based portfolio, at least in U.S. stocks, is down 0.91%, so at least outperforming that one. We do have some things that are up. Vietnam equities are up. Palladium's up. One biotech company we own is up. Uranium's up. European energy stock that we own is up. AT&T is up. As I mentioned, communications, and then European stocks are up a little bit as well. So it's not like everything's down, and that's that balancing act that we're trying to always pull off here. Okay, so yeah, this just shows you today. This is the S&P and the NASDAQ 100. This is the S&P equal weight and the NASDAQ 100 equal weight. So very, very bad breadth so far today. So gold, man, has gold been holding up, or has gold been holding up? Today it's giving back a little bit on higher interest rates, falling back below its 50-day moving average. We rolled our gold hedge this morning out a couple more weeks. We're very close to the money. I do think gold is susceptible to some serious downside action here, at least based on the technicals. That's a fresh sell signal right there, and that's a terrible looking bearish divergence in momentum. I am a very, very bullish gold for the next few years, concerned for the next few weeks and months. That's why we're hedging our position. Okay, so on tariffs, right? And who pays the price? So to some extent, certainly the foreigners can pay the price, and are, I suspect, by lowering the price of the good to the U.S. importer so that the U.S. importer may still buy it, because it's the importer, make no mistake, it's the U.S. company that writes the tariff check. You know, you hear people say, oh, China's paying us billions. Well, only if they're lowering the price by billions. And that doesn't flow to the Treasury. It's the check that the U.S. company writes that flows to the Treasury. So, and they have collected billions in tariff revenue. So maybe that cost is shared to some extent by an exporter from a foreign country lowering their price. But make no mistake, the actual revenue is coming from U.S. companies writing those checks. And I actually did and worked on an analysis yesterday of the hit to various companies, and it's very interesting. And it's not horrible necessarily right here, but it's not great either. And it all speaks to this right here. So this is a chart that shows that the aggregate profit margins for the S&P 500 is sitting at close to 14%, 13.6%. The long-term average, folks, is 9%. And then I think the all-time peak is like 15%, certainly in modern history. So we are pushing all-time high profit margins right here. And I want to show you how that looks historically when margins come back. So if you're a company and you are having to pay an extra 15, 20, 25, 30%, whatever it is, for what you import, you got to figure that out, right? And if the consumer isn't of the mind or doesn't have the capacity to pay way up in price, well, you're going to take a hit. You know, Ford's taking a $2 billion hit. And I believe it was Tuesday where I ran through a list of companies and talked about the hits that each of them are taking. If I didn't, I'll probably do that because that was part of the analysis that we did yesterday. And so to the extent that companies eat it, all things equal, they're going to eat it in their profit margins. So, you know, take a look here again. Here is where we are right now. And this is the white here is the S&P 500, okay? So we are at peak profit margins. And when anything's at peak, right, it tends to come off of peak, right? And here we are at peak profit margins at that last all-time high. And you see they just came down a little bit and come back up. And you can see this is that correction that we had earlier this year. But here we were right before the 27% decline. Here we were beginning to contract before COVID, right? Here we were rolling over right before the great financial crisis where the market went down almost 60%. And here we were rolling over before the tech bubble where the S&P went down 50, the NASDAQ went down a lot more than that. So here's my concern, folks. We actually have, you know, the makings because of the trade situation of lower margins for U.S. companies. So what we're concerned about is what's that effect going to be, right, when these margins begin to come off the boil. Okay, this one took a little while. So that's just another thing that we need to be thinking about, and that's that, you know, looking below the surface layer when you see CPI not doing much, but when we see PPI, the Producer Price Index, popping like it did today, if that's not showing up in CPI, and it hasn't yet, well, then it's going to show up in margins going forward, or it could. So that's just another risk that we have to be cognizant of and thinking about. So again, it's not my nature to come at you with pessimism. It's not my goal. It's just for clients to understand why we are staying uber diversified, pretty liquid, and hedging against something severe to the downside. We're very happy with our results so far this year, but we're not taking anything for granted, I guess is the message. So folks, I think I'll just stop right there and let you go. Thank you as always for watching and listening. And again, either over the weekend or early to mid next week, I'll come back with more. Take care. Bye-bye.